Hi, Advanced Accounting. I'm about to go over how to complete a problem from your textbook. This problem from your textbook is in Chapter 4, and it's Exercise 3 that I'm about to go over. Here's the problem. Norge Company is an 80% owned subsidiary of Victor Corporation. The separate income statements of the two companies are as follows. So they have the sales for Victor Corporation, cost of goods sold, gross profit, other expenses, other income, operating income, subsidiary income, and they have the final net income. Okay, so the parent is Victor Corporation, the subsidiary is Norge Company. What's happening here is the parent and sub are selling inventory to each other. Okay, when a parent and sub sells inventory to each other, it doesn't matter the percentage ownership. You will still eliminate 100% until that inventory is sold to people outside of the organization. Okay? All right, so let's look at it. Next thing you want to get with inventory. You want to get who sold to who. This is why this is very important, so please write this in your notes. Whatever company sold to the other. So if the sub sold to the parent or the parent sold to the sub, you will figure out the gross profit only for the selling company. All right, so let's read. Norge Company sold 90,000 of goods to Victor Corporation. Boom. Who sold? The sub sold to the parent. So I will figure out the gross profit percentage of the sub only. Okay, so let's look over here, and it's already figured for you in this exercise. So I'm looking at Norge Company, and their gross profit is $37,500. So let me you can see I already started this problem on the board. So let me write it over here. The gross profit, here, let me write it in different color so it really sticks out. Once I get it off. All right, so the gross profit for Norge Company, this subsidiary, because they're the selling company, is $37,500. The sales are $150,000. You divide it out, and what you're figuring out is the gross profit rate. I like decimals, so I'm going to use 0.25. But that's how you get the gross profit rate. One more time, it's always the selling company only that you will figure out the gross profit rate for. Okay, so what happens is you have to eliminate the sales and the cost of goods sold at 100%. Even if, one more time, the parent owns less than 100%, it doesn't matter. Eliminate the sales and the cost of goods sold at 100%. So here's what it says. Norge Company sold 90,000 of goods to Victor Corporation. Boom. We're going to eliminate that 90,000. So I go to the board, okay, and we're going to put in sales for Victor, which is 220. We're going to put in the sales for Nordco, which is 150. And then we're going to eliminate $90,000. Put that in parentheses, okay? All right, so we go all the way across, and we're going to total this across, and that equals $280,000. Okay? All right, now I'm going to go to my cost of goods sold. My cost of goods sold for Victor is 150. My cost, and please be working with me. My cost of goods sold for Norco is $112,500. I'm going to eliminate this 90,000. So remember, you would debit sales and credit cost of goods sold to eliminate that. I total across, okay, and my cost of goods sold is, well, I'm going to hold off on that. Hold off. I'm going to show you what we'll do, okay? All right, so I'm going to go back to this in a minute because I want to show you how to figure out the unrealized ending inventory and realized ending inventory. Okay. So we have this gross profit percentage, it's 25%. We're going to do a T account. So what we're going to do is we're going to check to make sure that we come up with the correct ending net income. Always do these T accounts, they help you figure it out much easier. All right, so we're going to start with the internally generated net income from the subsidiary. We're going to get that by taking the $37,500, the gross profit, and we will subtract out the other expenses. And when we do, we come out to internally generated net income for Norco is $22,500. So I go over here and I put in the $22,500. Okay? That's at 100%. Don't take out any percentage yet. All right, now, I look in the problem, and here's what it says. It says that the Victor Corporation held 20,000 of the goods purchased from Norco Company in its beginning inventory, so they had beginning inventory, and 30,000 of these goods in ending inventory. So this particular problem had beginning inventory and ending inventory. If you read the problem, so I'll have you do different problems. If you read the problem and it says it's the first time that they sold to each other, they will not have beginning inventory, okay? So this particular problem, they do have beginning and ending, and the beginning is, one more time, I gotta grab my book. The beginning is $20,000. All right, so let me go over here and show you how you get this number. Actually, let me put it over here and then I'll erase it. So the 20,000, that's beginning. We're going to take that, we're going to multiply it by 25%, and that will give us the $5,000. Okay? All right, so beginning is your realized profit. So this 5,000 I'm going to bring right down here, and this will be realized. The ending inventory, I am going to take the 30,000. Can't find my eraser. So now this is beginning. Let's do the end. The end is 30,000. I multiply that by 25, and that equals 7,500. That is unrealized. Okay, so realized is going to add to the net income. Now we can recognize this revenue. Why? Because it's been sold to outsiders. Take good notes on that. Your beginning inventory is realized. It's sold to outsiders. Your ending inventory, the 7,500, nope, we cannot recognize that. That will decrease our net income. All right, so when we do that, we're going to take the 22,500, we'll add in the 5,000, we'll subtract the 70,500, and that gives us 20,000. Okay? Now, I like to do both. I know when I show you the answer, the publisher only does the non-controlling interest. All right, I'll show you the non-controlling interest, which is the same as the publisher. So you're going to take 20,000, you're going to multiply it by 0.20, I like decimals. And that will give you $4,000. All right, what is the 4,000? That's the non-controlling interest, okay? All right, now, I like to do the controlling interest as well. So I'm going to take 20,000 and I'm going to multiply it by 0.80. And that will give me the 16. That's what I'm going to put in for my T account for the controlling interest. All right, so now let's start with Parents Victory Corporation. Their internally generated net income, which is 35,000. Get that right from the book. All right. Then you're going to add in their controlling interest, which is 16,000. And that gives you 51,000. All right, that's your check. When you do this consolidated net income, it better come down to 51,000. All right, so what we're going to do is we're going to eliminate this 90. But now we're going to show this analysis over here. All right, so we're going to recognize gross profit, okay, and that is $5,000. So that 5,000 we're going to add, all right, we're going to add this, okay, I'm sorry, we're going to subtract that from cost of goods sold. So what we're trying to do is get the cost of goods sold figure. So think about that. What I was doing here was the net income. The net income, if you subtract from cost of goods sold, that will increase your net income. The 7,500, we're going to take that over here and we're going to add this. This is the unrealized profit. We will add this. If we add to cost of goods sold, that's going to subtract from our net income. All right, and when we do all this, all right, now we come to our cost of goods sold, which is 175,000. Okay, next, we're going to have this other income and other expenses. Let me explain this to you. So if you look at C, it says Victor Corporation billed Norge Company $5,000 for computer services. The charge was expensed by Norge Company and treated as other income for Victor Corporation. Okay, the parent and sub cannot sell to each other. So we're just going to eliminate that in its entirety. The net effect of that is 0. The truth be told, if you even miss that in a problem, you will still come out to the correct answer. Why? Because it's going to be eliminated at 100%. Okay, so let me show you that. I already had that up here just to make our life easier. So that will be eliminated in its entirety. We're going to consolidate across 40 plus 15. We will subtract out this 5 and that gives us 50,000. Okay? All right, now, when we go to our consolidated net income, we take 280, we'll subtract out our expenses, right? This is really a subtraction. We'll subtract out the 50, and that will give us 55,000. That's our consolidated net income. All right, now, we don't own 100%, so we have to take out only the non-controlling interest portion. Now, sometimes in class, students say, Professor Clay, can I just add that 16 up here? No, because you're already consolidated both the parent and the sub. You're not isolating this 16. So what you have to do is only isolate the non-controlling interest. So, distributed non-controlling interest, that's right here. That's this 4,000. We will subtract that, all right? So we put in the 4,000, subtract it, and now we come to our check, 51,000. So remember, always do the T account. Do that check first, especially when it has a difficult where you're selling merchandise inventory to each other and you're trying to figure out, you know, how much to add and how much to subtract. Always do this check and make sure they must always equal each other. Okay? All right, you're going to do a similar problem for me, and I will see that soon. Okay?